Hey, happy Friday, everyone. Good morning to all of the options traders out there. And I've got another good question for the group. And what we want to answer today is, are your trades beating chance? And I decided to do this because it's a little bit of a continuation from what we talked about on Wednesday with this square root pricing principle. And this is another instance where we're going to see that come into play. So what does it mean when we say, are your trades beating chance? And how can we determine it? And you're going to find out, if you get nothing else from this video, just how difficult it is and how many trades you would have to place before you could say that you are beating chance. So, good stuff. Let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So let's start off with the definition. What does it mean when we say to beat chance? This is something you hear a lot in just lots of different fields, but especially when you're talking about gambling or betting or in the stock market. So the question that we're really trying to answer, how can you tell if someone is good or just lucky? So for example, let's say that I claim I've got some type of ESP and I can predict coin flips. And you say, well, that's just impossible. Prove it to me. So I pull out a coin, I flip it, and I say, I think it's going to be heads, and it comes up heads. Are you going to be impressed? Well, of course not. Half the people are going to get that right. That's just pure luck. Now, could it be ESP? Could be, but it doesn't prove it. That's the point. This could easily occur by chance. So we say, all right, well, let's try it again. And I say, all right, I think it's going to be heads. Comes up heads. And I say, let's try another one. And you say, okay, but that still isn't really too impressive. Try it again. So I say, all right, I think it's going to be tails. And it comes up tails. We try it again. I guess tails, comes up tails. I guess tails again, comes up tails. And then heads, and it comes up heads. And what I'm trying to show here is that at some point, you'd have to start having doubts. You'd either say, yes, he does have ESP, or this is some type of a trick. And the reason that you're getting that intuitive feel is that you realize that at some point, it can no longer be due to chance. In other words, I would be beating chance. So even here with 6 might be, okay, that's looking a little impressive, but it could still be by chance. And we keep going, and I guess heads, and then I guess tails, and then heads, and all of these are coming up right. Say tails again, we get that, comes up tails, and suddenly you have to say, this has got to be a trick. If you don't believe in ESP, this has got to be some kind of a trick. Why? Because your intuition is telling you that at some point, this is just no longer lucky guessing. And what we try to figure out in statistics is, where is that point? And that's where we need some type of a statistical test, because people's intuitions are just not real good when it comes to statistics. Some people are going to say after the 4th flip, oh, that's impossible. Well, it's not. That could easily be due to chance. Well, would you say after the 5th or the 6th, the 8th? Where are you going to start drawing the line as saying, okay, I'm convinced that this has got to be some type of trick, or that I really do have ESP? Where is that line in the sand? Well, it turns out we could do some statistical tests, and here's what it turns out to be for these flips. If we're going to flip the coin 10 times, somebody would need to get 9 or more before you'd have to start raising an eyebrow and going, that seems like it's beating chance. Whereas a lot of people are going to think after the 4th or 5th that it's impressive. It's just not. That can still easily happen by chance. With 20 flips, you would need 15 or more. 30 flips, you would need 20 or more. You'd have to get 2/3 of them correct. 40 flips, you would need 24 or more. So now it drops off a little bit from 66% down to 60%. If we did 50 flips and you got 30 or more correct, then you'd have to say, all right, that appears to be beating chance. Again, roughly 60% of them. With 100 flips, you would have to get 61 or more to say that it's not due to chance. So even right here, I'm just trying to show how it probably goes against your intuition to think that you'd have to get 9 or more correct out of 10 before you'd have to start thinking that it's just luck, or 15 out of 20. So that's really what it means to beat chance. All right, now let's look at a more detailed example and some of the math behind it. And we'll get to how this applies to trading in just a moment. But let's say that you're going to take a multiple choice test and it has 100 questions. And we're going to give you A, B, C, D answers. So you've got 1 out of 4 chance of getting it right. Well, the question now is similar. How many questions would you need to get right to say it wasn't due to chance? Now, in statistics, we also have to give it some degree of confidence, what they call a confidence level. So a typical cutoff point is at 95% confidence. In other words, we're going to have a cutoff point, some line in the sand, at which I'll say, okay, this wasn't due to chance. And what this means is that if we were to do this experiment over and over, then 95% of the time you would come up with the correct conclusion. But 5% of the time you're going to get a false positive. You're going to say, oh yeah, this isn't due to chance when it really was. But that's only going to happen 5% of the time. So how would we do this? Well, it's a little bit of an involved calculation. If you've had statistics, you've probably done questions like this over and over. But the average, we have 100 questions, 1 out of 4, 25% chance of getting the right answer. So we just multiply those together. We have 100 questions, 25% chance, 25 would be the average number of correct guesses. So if we had lots of people doing this experiment, taking this test, let's say it's something that they have absolutely no clue on, they're basically just guessing, we would think that most people would get 25 just by dumb luck. So if you say, hey, I got 25 on this astrophysics test, doesn't prove a thing. You could close your eyes and throw darts at it and probably get 25%. So what we have to do now is say, well, where's that line in the sand? So to do that, we have to say, well, how big is the variation? So we have to look at our standard deviation. Remember, in trading, this would be the volatility. And that turns out to be, hey, there it is again, the square root. We have to take the square root of the number of questions times the probability of getting it right, 25%, times the probability of getting it wrong. If there's a 25% chance of getting it right, you have a 75% chance of getting it wrong. So we multiply those out, take the square root, we get 4.33. And what we're going to do now is to say I need some number that's above 25, but relative to this standard deviation. What is that number? So we're just going to figure out this formula right here, but we have to have a cutoff point. And for that, we need to go to a bell curve. And so to do that, if you go into a lot of statistics books, you'll see your bell curve, and we're saying, well, where is this 5% cutoff? There's a line here, this is called a upper tail test, a one-tailed test, where we want to know what the probability is of beating chance to get more than, let's say, 25. Well, where is that line? Well, it turns out to be right here. This orange area has 5% of the area. All right, well, where is that? Well, you can find this anywhere on the internet, but if you have Excel, you could do norm for normal distribution, .inv for inverse. We're figuring this out kind of in reverse. And we're saying, what's the probability? 95% chance, mean 0, standard deviation 1. That's just a normal bell curve. And it's telling us right there about 1.645 to 3 decimals. So that's where that orange area is coming from on the bell curve. It was 1.645 standard deviations away. And so if we go back to it, you can see there's 1 standard deviation, there's 2, there's 1.645, a little bit over the halfway point. So we just need to find out that line, and that's where 5% of this area lies. So again, this cutoff point, this is how we came up with it, is this 1.645, called a z-value in statistics. And when we solve this, we're just going to say some number minus 25 divided by 4.33 equals 1.645. That's our cutoff point. And it turns out that it is 32.12. So we need better than 32, let's call it 33 questions correct out of these 100 questions to say that it wasn't due to chance. We'd have to lean more towards that this person actually knew some of the answers. Okay, so that was a more detailed example of what it means to beat chance. It's really a statistical idea, and it can get fairly involved, but what does it have to do with trading? So let's say that the volatility of a certain stock is 30%. Now remember, what traders call volatility, statisticians call the standard deviation. So it's exactly the same concept. But this stock has a volatility of 30%, and the return, let's say, of this trader after a year is 10%. And the question we're asking is, did this trader beat chance? Should we be impressed with this 10% return? And once again, this person might say, oh yeah, I use RSI or Fibonacci, and look at this great return that I've done. And I've done it for several years. And so therefore I'm on to something. And so the question we're trying to ask here, how do we check this? How can we see if this person has beaten chance? Well, it turns out to be a fairly simple calculation. We're going to take this 30% volatility and divide it by the return that this trader did. So 30% divided by 10% gives us a factor of 3. And what do you suppose we do with this number 3? We square it. And it would take 9 years of data to see if this 10% was different from chance. And that's just the one standard deviation level. That's just to have 68% confidence. It would take 9 years. And yet there's a lot of traders that'll brag because they've done 8 or 10 in a row. It's completely meaningless. That can happen all the time, just like guessing 3 coin flips in a row. It's not the least bit impressive, but people think that it is. What if we had a 40% volatility up here and the trader made a 10% return? Now we have a factor of 4, and we'd have to square it. It would take 16 years of data to see if this 10% has beaten chance. Or was it just something that lots of people would do just because they're trading in a 40% environment? So again, I thought that was another use of this squaring principle that we see a lot in many areas, like we saw on last Wednesday's video. But this is a very practical one because it can help to keep your head straight when you hear some of these what seem to be astounding returns, and you find that the person is just trading a 60% volatility stock for the last 6 months. Most of the time, they just got lucky. But how do we check it? This is where we find out, did you beat chance? And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.